Today we're going to discuss how to find liquidity. In order to find liquidity, you have to understand how market orders work. So if you're buying the market up, your stop loss is a sell order. Because if you're buying the market up, in order to get out of your position, you have to sell the order back. Whether you're selling it in profit, which would be a sell limit, or you're selling it at a loss, which is a sell stop. So anytime you take a long position, below where you got in is a sell stop. The same is true for a short position. Wherever you're selling the market, in order to get out, you have to buy the order back. If you're selling to get out of your position, you have to buy it. If you're getting stopped out of your position, it's called a buy stop. So above old highs are buy stops, and below old lows are sell stops. This is where liquidity lies. Liquidity lies in these buy and sell stops, and liquidity also lies in fair value gaps, which we talked about last week. In order to draw your buy side liquidity and your sell side liquidity, the easiest method is to draw the old highs and the old lows, because you know that buy stops and sell stops rest right above and beneath. So for example, this is how I draw it. I have buy side liquidity up here, and I have sell side liquidity down here. BSL stands for buy side liquidity, SSL stands for sell side liquidity. Price always targets liquidity. So if we scroll to the right, we see that price came up, took buy side liquidity, immediately sold down, traded back up into a gap, because there's liquidity in gaps. There are no stops in gaps, but there are liquidity in gaps. And then came all the way back down and took out sell side liquidity. Now, the higher the time frame the liquidity rests on, the more volatile and the more explosive of a move you will see afterwards. For example, we took out a daily low from June on September 30th. The following 2 days were super explosive bullish movements up. Now, this is just a daily chart, so this takes a long time to form. But the same thing happens every single day in lower time frames. You can use your old highs and your old lows as targets, and even to help you not take a trade. So for example, let's go to the hourly. If you look at price this morning, it ran up into a gap because there is liquidity in gaps. There are no stops in gaps, but there is liquidity in gaps. It ran up into a gap. It also took out buy side liquidity, traded back down into sell side liquidity, reversed back up, and is now currently playing around. However, where it stopped today is not random. We can label this sell side now because that would be our next target for another short. If price presents itself showing that it wants to go lower, you can use these as targets for your shorts. But it did not stop in a random place, because if you zoom out, you can see price traded into a fair value gap. And there are two of them here, both hourly. Let's make this a tad bit bigger. Price traded into this bullish fair value gap, back out, and up, and retrace back up today. Price is not random. It trades liquidity to liquidity, premium to discount, discount to premium. The entire time it is searching and seeking liquidity. It is seeking those orders so that it can turn around and go in the opposite direction every single time. And what's cool about liquidity is it happens on all time frames. Obviously, like I said earlier, the higher the time frame, the more of the explosive move you will see, the more sensitive to that area price will be. But if you're looking at it in a sense of, oh, I'm trading today, where could price be going? Well, this morning you wake up and you see prices at a fair value gap above buy side liquidity, all right before 9:30. And then 9:30 comes and we sell down, and we retrace and we keep selling down. But how would I know to be bearish? Well, let's remove all these drawings. If you go to a weekly chart, you can see that price does this on higher time frame as well. We took out a low last week. We formed a weekly gap 2 weeks ago. Last week, we retraced more than 50% of that fair value gap, and we could not close inside of it. Knowing what you know about a fair value gap, when price does not close it or cannot close above it and sells back down and closes below it, 9 times out of 10, that is indicating price wants to go lower. So knowing this before this week started, you could already have a bit of a bearish bias because, hey, we tried retracing. Price said no. We ran into weekly gap liquidity and sold back down. So this morning, looking at your charts, you should already be thinking, well, we already ran up, so any false run up here is manipulation, and I'm going to be looking to go short. You can go to the daily and also see that we formed a gap now here. And what does price do? It seeks liquidity. So in order to get below this old daily low, we're probably going to need to trade into this fair value gap and then back down. So using liquidity on a higher time frame can allow you to, one, either swing trade. You could swing trade options in these higher time frame price sensitive areas, or you can just wait and use these areas to help develop your bias for the week. So I automatically know that if price trades back up into this gap, I'm going to more than likely start looking for some shorts in my intraday trades because, hey, why else would price keep randomly going up? Now, there are equal highs, which can act as liquidity here, but that's when you start taking a look at the news, because the news is going to give you the powerful move that you want. And the more you look at liquidity, the more you'll ask yourself, is liquidity predicting the news, or is news predicting liquidity? However, this is how I draw liquidity and use it every day to trade. I will even use internal ranges to get out of my trades. I use them as targets. I'll go gap to gap, or I'll go buy side to sell side, or I'll go internal sell side to external buy side, or external buy side to internal sell side. And for example, that would look something like this. 15-minute chart. If we didn't see this morning and we went to replay, starting here, all we know is that there's liquidity up here and down here. But let's say I don't want to hold the trade all the way to this sell after we take out buy side. So we run up, take out buy side, take out buy side again here and into that gap that we saw. And let's say that I see that we're going to short, right? So we come up and we tap into this gap here. And I'm already thinking bearish because I've seen the weekly chart, I've seen the daily chart. I see that price cannot continue, but I want to take a short, but I don't want to short all the way to 36.23 because what if we don't get there? So then you exit at internal liquidity, which would be here, internal sell side, and we'll label this sell side liquidity. And we have more here, also internal sell side liquidity. So instead of risking your entire trade and risking a potential reversal, you can exit here, 36.43, 36.37, and there's a gap here, you can exit. Knowing that these levels of liquidity are here is very helpful because it can keep you from taking a bad trade as well. If I know that price is selling down, it's taking out one level, that would have been my first exit. taken out 2 levels, now in the gap and starting to push back up a little bit. Why would I want to short now? Granted, it could come down here 36.23, but does that make it a good risk to reward? No. Now look at that. Imagine had I tried to short here and price runs back up and stops me out. Knowing where liquidity is and where it's likely to reverse gives you the keys to taking a high probability trade. It's not about, oh, I entered perfectly on the sell, or I exited perfectly. It's, oh, I got in and got out. I got what I needed before price could wreak havoc on me. I sold it down before price, and I sold it down and I got out before price could reverse. Or I bought it up and I got out before price could reverse. And now price does its job, comes all the way down, sets equal lows, and anytime price sets equal lows or equal highs, that makes it a target. It is going to come back for those highs and those lows at some point. And then it destroys those equal lows. But I would have had no narrative on price if I didn't look at liquidity on the high time frame. I wouldn't have known where to exit. I would have gotten stopped out trying to short too late. Or I could have just been totally wrong and tried to go long from the beginning and would have got clapped. Liquidity is your friend. It helps you formulate your bias, your narrative for why price may go where it's going, and it allows you to see, price is selling, where is it going? You're 9 times out of 10, you're going to be able to see where it's going and figure out where it could stop, or jump along for the ride if it makes sense to your risk to reward ratio. Liquidity is powerful. The goal always is you want to be buying people's sell stops and selling people's buy stops. That's why a lot of people who trade support and resistance tend to get destroyed because, hey, this is supposed to be support. What does price do? Run right through it. It's going to get those sell stops. Well, hey, this is supposed to be resistance. What does price do? Run right through it. The flaw in support and resistance is that you don't know when it's going to run through it or not. The beauty of liquidity is it allows you to know where price is going and allows you to be patient and let price tell you what it wants to do. Not try to buy a random line or sell a random line. You're exiting and you're entering at liquidity. Beautiful. Hopefully this was helpful. Let me know in the comments, like, subscribe, and thanks for watching.